Your next reading is Basics of Portfolio Planning and Construction, and these are the specific learning outcome statements. First LOS says describe the reasons for a written investment policy statement. We have discussed this previously, but let's just redo it. Investment policy document, or IPS, is a document governing the process of constructing a portfolio so that we can meet the client's investments objectives. So what are the influences on the IPS? What are the elements that are to be considered? First, it might be legally required, like in the UK, pension schemes must have a statement of investment principles under the Pensions Act 1995. Then the second need, why do we need an IPS? So that we can outline the client's needs and preferences. And of course, the last reason, governance arrangements. We can outline the procedures for appointing pension managers, for example. So let us see what are the benefits for clients and investment managers, the benefits of IPS. First, for the client, the IPS identifies and documents specific investment objectives and constraints for the client. The IPS can easily identify areas that need changes in response to changing circumstances. Developing the IPS should be an educational experience for the client. He would get to know newer things. The client will learn more about themselves and investment decision making. And finally, for the client, management can change hands without disruption of the investment process. For example, first your investment manager was A. Now your investments are being managed by the manager B, but you don't have to be worried because the manager A and B, they will both be following the IPS, so you don't have to be worried. Then there are certain benefits for the advisor or managers as well. Greater knowledge of the client, you would know what the client wants, guidance for decision making, guidance for resolution of disputes. If there is an issue, we can refer to the IPS to resolve the issue. And of course, it can be used to support the manager's investment decisions, because manager investment decisions are based on IPS, so you can defend, as a manager, you can defend your decisions taken. Then we have the next LOS. It says describe the major components of an IPS. We have discussed this in our previous reading, just a quick overview. First, there will be introduction, that would be the description of the client. Then statement of purpose. Why do we have this IPS? Statement of duties and responsibilities of client, advisor and custodian. The procedure, specifically the investment procedure. Investment objectives, for example, the target rate of return. Investment constraints, specifying what we can invest and what we can't, minimum shares in certain asset. Investment guidelines, that is the permissible assets, which assets we can invest in. Then of course the evaluation and review, the performance feedback, how well the investments were managed. And then of course the appendices that will contain the strategic asset allocation and the other tactical assets allocation details. So this is the major components of IPS. Then describe risk and return objectives and how they may be developed for a client. Risk objectives can be stated in absolute terms, stated without context, and they can be relative, that is stated comparatively. For example, when we say absolute risk objective, that is, for example, the year 95% value at risk of the portfolio must not exceed $10 million. And when we say relative, for example, achieving a return within 5% of S&P 500 index, approximately 95% of the time, that would be the relative risk objective. And this is absolute, where we have the absolute amount specifying the risk objective. Then return objectives can be divided into the following needs. For example, the capital preservation. Capital preservation means capital should be maintained For instance, by earning a return equal to the inflation rate. Whatever is being invested, that must be maintained. Then capital appreciation. Capital needs to grow, not just merely preserved. We need growth, for instance, by earning a return that exceeds the inflation rate. So just maintaining the inflation rate, that is capital preservation. Earning something above the inflation rate, that is capital appreciation. And then, of course, sometimes we need income as well. Your capital needs to create income from the investor's capital base. Okay, with the passage of time, your investment will generate some returns. Right, so the capital base needs to grow, either through capital appreciation, right, or further reinvestment of that appreciation. So it needs to grow. That will give you the total return, the growth in the capital plus further investment. Then distinguish between the willingness and the ability, also called the capacity to take risk, in analyzing an investor's financial risk tolerance. Willingness to take risk. It depends upon the investor's beliefs. Investor's willingness to bear risk is based primarily on investor's attitudes, his beliefs about various types of investments. He strongly believes about any investment, he would go for it. It also depends upon the knowledge about financial markets. If investors got good knowledge of the financial markets, then he will be more willing to take risk. So assessing an investor's willingness to bear risk is fairly objective and very difficult sometimes to comprehend. So it may involve the administration of questionnaire in an attempt to categorize the investor's risk aversion, whether he's risk seeking or risk neutral or risk averse, or to what extent he shows risk aversion. And it also, of course, depends upon his abilities. If he has experience in investment, he's confident about his decisions, then he will have more willingness to take risk. And whether he is daring or risk averse, of course, it will also determine his willingness. Then this is more important. Ability to take on risk. Abilities to bear risk depends upon your pockets, how deep your pockets are. So investor's ability to bear risk depends on his financial circumstances. If he has strong financial base, good salary, good savings, got lots of assets, less liabilities, that means he is able to take on risks, right? Investor can take longer investment horizons. It means he's able to take on risk. He has more assets than liabilities. It means he has more ability to take on risk, more insurance, and of course he has a secure job. So all these will determine his ability to take on risk. So willingness is how much risk an investor is willing to take, and ability, how much capacity an investor has to take on risk. And these two combine the risk tolerance. Ability to bear risk, higher income relative to expenses, secure job, significant asset versus liabilities, time horizon of 30 years. So this shows the investor has ability to bear risk. And willingness to take risk, deep knowledge about financial markets, and answer to this question we discussed here in this point. They combine gives the total risk tolerance of the investor. Then willingness versus ability to take on risk. Yes, this is important. Sometimes, but not always, the willingness to take risk is not consistent with the ability to take risk. For example, a person who is earning a net amount of, after all the expenses, about just $20,000 per annum, he doesn't have the capacity, he doesn't have the ability, but he is willing to take on a risk that is maybe 4 times this amount, right? So this could happen. There may be inconsistency between the willingness to take on risk and the ability to take on risk by a particular investor. For example, here's an example given. In a well-funded pension plan, the trustees and beneficiaries may wish to adopt a low-risk investment approach while the plan sponsor wants to invest more aggressively. In such a situation, the trustee must always act in the best interest of the beneficiary, not the sponsor. Right? That's an important point to be remembered. Then, next LOS says, describe the investment constraints of liquidity, time horizon, tax concerns, legal and regulatory factors, and unique circumstances and their implications for the choice of a portfolio assets. Okay, let us discuss these one by one. First, liquidity. Liquidity refers to the ability to turn the investments into spendable cash in short notice without giving significant price concessions. Like, for example, if I have an investment of $10,000, right, I can convert this investment into spendable cash maybe just at $9,995. This $5 represents the transaction cost, right? So I didn't give significant price concessions, just the transaction cost. So that's what we mean by liquidity. The ability to turn investment assets into the spendable cash in short period without giving significant price concessions. Now, if you are a portfolio manager and managing investment for your client and you know your client's specific needs, then you will keep a certain investment part liquid. Maybe 70% in the long-term investments, 20% in bonds and other assets, and then the remaining 10% is cash. That's important. Or even not cash, then those allocated assets that can be quickly converted to cash at a particular point in time at which your client needs to meet some financial obligations. Similarly, the client who needs liquidity at short notice, so we won't recommend illiquid investments like in hedge funds and private equity funds, which typically have trading and redemption restrictions. So such investments are not suitable for an investor who may need unexpectedly cash for his needs. Then time horizon. The IPS should state the time horizon over which the client is investing. 5 years, 10 years, 13 years, 40 years or whatever. So the longer an investor's time horizon is, the more risk there is, and of course less liquidity the investor can accept in the portfolio. So time horizon is also as a measure of willingness and ability to take on risks. Longer time horizon would indicate that the investor is willing to take on more risk and is willing to accept less liquidity in the context. Then tax concerns. Yes, and this is a very important consideration. Different investors will have different tax statuses, which should be stated in the IPS, right? The investment manager should also consider the different tax treatments of various types of investments. And then finally, of course, the specific preferences of the clients. Sometimes investors who are subject to high tax rates, they would prefer investments in tax-free bonds, right? And then if there is a difference between capital gains tax rate and income tax rate, so if the capital gains tax is higher, then the investor would prefer to invest in those assets that generate income. But if the income tax rate is higher, then the frequent buying and selling of investment would be preferred. So this tax is a very important consideration in investment management. Then legal and regulatory factors. The investment policy statement should contain any specific legal or regulatory restrictions that are applicable. Like if an investment manager, he's managing the investment account of a trust or a corporate investment account, then in that case there may be lots of restrictions by law. from investing in particular types of securities. Then unique circumstances. The investment policy statement should also cover any unique circumstances that are applicable. For example, investment restriction in countries accused of human rights abuses, religious preferences, and especially ESG concerns, that is the environmental, social, and governance factors. Then we have explained the specification of assets classes in relation to asset allocation. It's a step-by-step approach. Once the IPS is specified, the advisor then can begin to construct the portfolio. The asset classes need to be defined, and then a strategic asset allocation is formulated. After this, correlation of returns within an asset class A, asset class B, C. So within the asset class, between investment A, B, X, Y, Z must be high. So correlation of returns within an asset class A should be relatively high. An indication that the assets within this particular class A, they are similar in their investment performance. But remember, there should be low correlation of returns between asset classes, as is between A and B and C. So that would indicate that the asset classes have different investment performances. Then we have the next LOS, describe the principle of portfolio construction and the role of asset allocation in relation to the IPS. Once the portfolio manager has identified the investable asset classes for a portfolio like A, B, C, three assets we have selected based upon different risk, return, and correlation characteristics with each other, an efficient frontier can be constructed with the help of a computer program. I'm sure you would know what is efficient frontier from your previous readings. So once we have identified the asset classes, we will develop efficient frontier using the computer models. Then now we have IPS on one hand, the guidelines, risk return guidelines contained within the IPS, and we will have the actual risk return properties of the portfolio that you've constructed. By this comparison, we can develop optimal portfolio. We can identify optimal portfolio. In addition to the strategic asset allocation we discussed previously, like let's say this is the asset allocation, we have invested 30% in A, 50% in B, and 20% in C. We can also have tactical asset allocation. What is tactical asset allocation? That the investment manager may vary from the strategic asset allocation weights, maybe 10% in A, 80% in B, and 10% in C. Why? In order to take advantage of some short-term opportunity. So this is called the active portfolio management. So while such an active strategy may produce higher returns, but it also increases the risk of portfolio compared to a portfolio which is a passive portfolio of asset class indices. So in this tactical asset allocation, we can manage risk via risk budgeting and rebalancing. We have discussed this in our previous reading. Now the last LOS says, describe how environmental, social, governance considerations may be integrated into the portfolio planning and construction. Different approaches to ESG investing and their issues. We have already done this in our corporate governance reading. So ESG stands for environmental, social, and governance considerations in investing. So there are a few terms we'll just read. We have done them in previous reading, but just go through them. Negative screening means excluding specific companies or industries from consideration for the portfolio based on ESG factors. Positive screening, or sometimes called the best-in-class approach. In this approach, we invest in those companies that have positive ESG practices. And thematic investing means investing in those sectors or companies in order to promote specific ESG-related goals. It may require an investment manager who specializes in this style of investing. And then finally, we have active ownership investing. Using this approach, we own a certain percentage of shares in a company, and using these voting rights, we influence the management or the board to take specific actions to address the ESG concerns. And that's all. That completes your reading basics of portfolio planning and construction.